Hello, everyone, and thank you for joining us today. Welcome to the 2026 Grain and Biofuel Outlook webinar. Before we get started, I'd like to offer a few technology tips to keep in mind while you're viewing today's webinar. First, all attendees are muted throughout the presentation. Once in a while, it's a good idea to tap your mouse so your screen does not go to sleep during the presentation. There will be time for questions and answers at the end of the presentation. Questions can be submitted at any point during the presentation. To send in your question, click on the question mark button on the right side of your screen and expand a question box to type your question. And then lastly, a recording of today's webinar and presentation materials will be available at farmcrediteast.com and on our YouTube channel. And then a quick disclaimer, this information is presented in good faith and is not intended for investment or tax or legal advice. I will now hand it over to my colleague, Chris Lawton, who will introduce our speakers.
Thank you very much, Kelsey. My name is Chris Lawton. I'm with Farm Credit East. I'm the Director of Knowledge Exchange. And today we're lucky to have two expert presenters from our affiliated farm credit institution, CoBank. We have Tanner Ehmke, who is the CoBank Lead Economist for Grains and Oilseeds. And we have Jacqui Fatka, who is the Lead Economist for Farm Supply and Biofuels. Jacqui, I believe you're scheduled to start first. So I will let you take it away. We just need to switch and share your screen, and we'll let you run with it.
Excellent. All right. We will go ahead and gonna share. And let me know if that comes up full screen. Is that good?
We see your PowerPoint. You might just need to go to presenter presentation mode.
Yep. Slight difficulties.
I love technology, right?
Okay. All right. We good
Perfect.
now?
Yeah.
Awesome.
Perfect.
Well, thanks for your patience, everyone. Tanner and I are looking forward to sharing some of our insights today with everyone who's on the call. A lot of things to talk about, especially after yesterday's report. And so we're just going to dig right in. I'm going to start off with just an overall look at the agricultural economic outlook right now. As we're coming out of 2024 and finalizing the 2025 net farm income, obviously it is a lot different for crop producers versus the animal producers, and I'll dabble a little bit on the livestock side of things, but most of our focus will be on the crop side today. But you know, we've seen definitely a huge shift in more receipts coming in on the animal livestock side of things, a little bit lower production expenses for crop producers, and government payments is another major component of what's making up the overall economic health of the ag economy. And so we're going to talk about that a little bit more too. You know, as we look forward for 2026, obviously continued tight margins and low commodity prices have most of the regions around the country anticipating ag borrowers are going to be not profitable, right? So, you know, this chart shows which this is from the ABA Farmer Mac Ag Lender Survey, questioning how many of their share of ag borrowers they believe will be profitable in 2026. And you see here, most of those regions are underneath the 50% threshold. And as we look at the country as a whole, only 50% of share of ag borrowers are anticipated to be profitable. Again, you know, as you look at just the livestock side of things, some strength and opportunity there for cattle and poultry are driving those livestock gross income growth. We continue to see a shrinking cattle herd, but yet high demand there, and strong demand as well moving forward for poultry. So when it comes to just overall consumption of these main proteins, continue to see growth in chicken and pork and turkey, a little softening in the beef, and part of that is just because of the high prices. We have seen a little bit lower projection moving forward in what demand would be. So turning more to the crop side, though, as we look forward to 2026, again, the crop season that we're heading into, across the board, continued high input cost projections for cost of production for the year ahead. Those star ones are actually record high, so we've seen a continued climb in some of those key segments. You know, and when you're talking about just being able to manage these tighter margins, harder to adapt to increasing commodity prices that we've seen the last 3-4 years, in light of the fact that we've had low commodity prices. And Tanner will be able to talk about that more following yesterday's very big crop report that we had out. Going back to that first slide that I showed, such a huge part of the overall economic health for the agricultural community is the government payments. And as you see here, this gray bar is other payments, which would be a lot of these ad hoc assistance payments. We've had a considerable amount of additional money coming from the government. As you look back to 2020, that green and blue bar, and 2020 and 2021 was some of that pandemic assistance. As you look in 2025, we had the Emergency Commodity Assistance Program payments that were last March. And then as we look forward to next year, again, additional money that's coming in from the new Farmer Bridge assistance payments that were just finalized right at the end of the calendar year in December. This is actually another bridge payment, just like that ECAP payment that was made last March. These payments are going to be made in February. So when you think of the timing of when these are going to be paid, similar somewhat timing ahead of the growing season, but a lot of those input costs have already been purchased. And that's, you know, as you look again back to that cost of production chart that I showed just a few ago, very high cost for rice and cotton. And so that's why you're seeing an increase overall in their Farmer Bridge assistance payments for this round of ad hoc assistance, just because we've really seen a significant struggle there in those two commodities. Most of the other ones are pretty nominal in the increase. You know, soybeans and corn, not a huge increase from the 2025 payment versus the 2026 payment that's going to be coming. The other interesting thing to know about these farmer payments, ECAP did have 85% was paid out in the March, and then they topped up that at the end of the year. Late in the fall, they had the rest of the 15% of that, and part of that was just because they wanted to make sure they had enough money to ensure that everybody that needed those payments received those payments. From what I understand, on this round of the Farmer Bridge assistance payments, all of those payments will be paid up front, and so you won't have the two installments of that payment. And, you know, a lot of people are thinking, well, you know, $44 for corn producers, $31 for soybean producers. How does this impact just the profitability and those producers being able to make money on this growing season ahead? And as you look here, we're still seeing cash income for corn producers. The median producer, we're still going to be losing a little money. as well with a high cost producer. Now, the lower cost producers, especially those who own a lot of their farmland, they would be able to still be making money. But overall, about half of corn farmers are still going to generate a loss for the upcoming growing season. As you look at soybean producers, the median producer there is actually making money still, as well as the high cost producer. So you're going to see about a third of soybean farmers are still going to generate a loss for the 2025 season. Now, some of these numbers were figured in prior to yesterday's report. And so again, a lot of just the overall ability for producers to find margins, profitable margins, is going to depend on when they sold their crop, and when they sell their crop here moving forward, and what kind of yields they can capture in the 2026 growing season. As I mentioned, those payments aren't going to be going out until February, and most of the crop inputs have already been purchased either at the end of last year, or some of them may have rolled it forward into January. But predominantly, most of those input decisions have already been made. A lot of them have already been paid. So, what is that money going to be used for coming from these new payments? A majority is going to be used for paying down debt and improving working capital, as we've seen over the last several years with the decreasing commodity prices, the ability for farmers to just finance what they need. They've had to some of them have had to turn to operating loans and turning towards needing to have more working capital. So this is going to go towards that, as well as the debt. A lot of interest rates have been obviously higher here in recent years. That's impacting those who have purchased land or inputs as well. So just being able to pay down that debt is a lot of what will be used with that $12 billion, $11 billion for row crop farmers as we move forward this year. Looking back though, and this is Illinois, and I would say, probably pretty similar to a lot of states around the country, we have still been able to see, especially those higher producing farms, having the ability to pay down their debt. We're seeing some challenges there here in the last year, but we still have. That's why it is important that some of that money is being able to go back out to pay down debt or apply to the working capital. A lot of times, just overall health of the farm economy also depends on where we see cropland values. And as we have looked the last not quite 2 decades here, we did see a pretty moderate leveling out of crop prices there during the last real low turn of the crop cycle. Prior to the last couple of years, though, we've seen extremely high increases in farmland values. And Tanner and I talk about this a lot. We really thought heading into 2025 that we would see a softening in land values. And that really wasn't the case. As you looked there in the Midwest, where we have these, the I states, especially Iowa, for instance, had farmland values up 5%. But even in the South and in the East there, for many of our listeners, I imagine you continue to see very elevated land prices, strength there. I always remind folks too that land is often driven by location. If that farmer is looking to expand and that neighboring farm comes up and they have the ability to maybe shift some of their previous equity through land and be able to spread out that payment, they're going to look to do that, especially those producers who have a plan for the next generation of return to their farm. Consolidation and just further expansion and efficiencies are gained by those producers who have the ability to do that. And so that's an important indicator that we're watching as we go forward. Do we see continued strength in the farmland values? Is there some softening? Do we have fewer farmers who are bidding bidding on that, which, we are starting to hear that there are fewer farmers active in the market, but also we're hearing some no sales. But will that continue? If we see continued softening and just the weakness in the margins and ability for producers to make money on that land, do they see this as an opportunity to get out? And I think especially too as we move forward and so many aging farmers evaluating where they see agriculture in the next 10 years and their role within that, we could see an increasing number of acres come into the system, which would again soften land values, because we would not have some of the limited supply that we are dealing with now. That farmland values is one of the big reasons why I don't think we're in the same situation that we were in the 80s. When you look at just that debt to asset ratio and the debt to equity ratio, and then just the divergence there of that total rate of return on farm assets, we do not have that huge difference there that we saw in the 80s. We've seen little pockets of some divergence, but nothing that's concerning yet. The other big question we get often is just what we see in the farm bankruptcy numbers. And as you looked at the Chapter 12 filings in the first half of 2025, we did see an increase number of filings in some of our areas, Iowa for one, but then you had Arkansas and Georgia, some of those areas where those southern crops, rice and peanuts, were more prevalent. And so you saw some of the stress. We're seeing more reports too of a lot of rice farmers deciding to exit the rice business after generations of being rice farmers. But when you look just at the overall trend of even the last 5 years with bankruptcy filings, we've seen an increase for 2025, but we're not even to where we were in 2020. Obviously, levels were really low in 2022 and 2023 because of the fact that we had really high commodity prices during that time. Switching gears a little bit, I'm going to look into just where we see things with biofuels, really important demand driver domestically, and especially important as we look at what yesterday's very high crop production report told us and the amount of crops we're going to need to use. So biggest kind of deciding point on the soybean side of things is really what EPA decides to do on a couple different issues. So they did propose their renewable fuel standard, renewable volume obligation, the RVO components in last summer, but we're still waiting for that finalization of that rule. But within that whole rule, we also need to decide how we're going to handle the small refinery exemptions and whether that will be reallocated. So for instance, if a small refinery is given an exemption, does that get reallocated to the larger ones, or does it just wipe it out completely? And so that's really important on the demand side of things, of whether the actual mandate will be full mandate or if those reallocations will water down what actually that mandate would be. The other kind of interesting side note from the last year's proposal on the RVO, EPA proposed that the renewable identification numbers, the RIN values, that any imported feedstocks would only get a 50% RIN value. And so again, this is very important for domestic demand as soybean oil competes with used cooking oil imported in, or even Brazilian beef tallow. Being able to capture a higher RIN value here domestically for domestic feedstocks would really create an incentive for those blenders to use those domestic feedstocks. And so whether EPA does finalize their proposal with that 50% reduction, if they do that in just 2026, do they do it in 2027? There's been mixed reviews. Obviously, some of the blenders have said that that's not very feasible. Meanwhile, our domestic crushers see that as a great opportunity to build demand for soybean oil, especially in the face of lower soybean exports that we continue to see because of China's exit from the market. I shouldn't say exit from the market, reduction in U.S. Imports of our soybeans. So as all of this, as we've turned the calendar into 2026, the longer we go without a decision from EPA, it continues to sow uncertainty into the market, and it pushes out just being able to capitalize on that mandate because of the fact that that was supposed to go into effect January 1. So as you look here too, biomass-based diesel was the biggest winner in the new set rule with a 61% increase. The set rule, the last time, so for years, biofuel policy was every year we would have to have these RVOs. Then in 2023 was the first time that we had a multi-year set rule. And the problem with that previous set rule was that they really underestimated demand coming out of the gate. Despite the industry being pretty vocal in the comment period about this ability to use some imported feedstocks and just knowledge of the capacity growth that was happening in the industry, they set it pretty low. Now the 2026 and 2027, very encouraging increase there. The industry is very optimistic that they would easily be able to meet that goal. And it would be great to be able to have that additional demand boost through this higher RVO for the biomass-based diesel, which is really biodiesel and the renewable diesel are the major two components of that target area there. So a lot of times we talk on just the ability for domestic demand to offset what we have lost with China not importing as much of our soybeans. So, how many new crush facilities would be needed to replace that lost Chinese demand? We figured that would be about 3 new crush facilities. Now we've had over $6 billion in investment in recent years. We continue to see crush facilities come online that were first developed a couple years ago. So we are expanding crush capacity, continue to reach record levels. I know NOPA is going to have their next numbers out tomorrow, the 15th, which is Thursday, and we continue to see record amounts of domestic soybean crush, which is great for being able to use that locally, but it's also not very feasible to think that we are going to be able to bring on 3 more crush facilities because of those lost exports, especially if we don't have those high RVO levels from EPA within the finalization of their RVO levels. So right now, about 50% of our soybean are used for biofuels. If we had this, EPA actually projects we could have an additional soybean oil demand of 3.8 billion pounds in 2026, with that higher proposed level, in addition, 1.9 billion pounds in 2027. So really being able to help utilize a lot more oil here domestically. Now the flip side of that, we still have to find some place for our soybean meal. Whenever you split that bean, you get oil and meal. We've been able to see some increase in exports of the meal, but that continues to challenge, again, back to can we add more domestic crush capacity here, because you need to have demand for soybean meal as well as the demand for soybean oil to make that profitable for those crush facilities. So again, back to just the different components of what you would need. to make the RVO work. And I mentioned the RIN value for if you have a 50%. As you look forward here and just simplified what this means, if we have a half RIN on imported fuels and feedstocks, that's this black bar. If you give that full RIN value on imported feedstocks, it actually, you can clearly see that soybean prices would be projected lower. These are soybean prices. And then if you have a higher feedstock supply, not as much of a drop in prices, but still a lower outlook there for soybean prices. And again, going back to the just overall cost of production, we can't afford to have much more of a hit to soybean prices, and so every little bit is important. The U.S. crush industry is obviously calling for that half RIN proposal to go forward. So we'll see where EPA lands on that. And then the other thing too, as I mentioned, what happens based on those reallocations of the SREs. And again, if you have that 100% reallocation, so if a small refinery is granted that exemption and it's reallocated completely somewhere else, you see a slight boost in soybean prices. If you have a 50% or 0% reallocation, obviously that the price would be going down from the base case. Great story to tell on ethanol this year. We just had the new numbers out last week. We continue to see very strong ethanol exports. We saw a record-breaking 2024, a very strong 2025 for the first several months there. Ethanol exports were up 25% from September. Canada remains a very important market for us, as well as exports to the UK and South Korea increasing 5 times from the month prior last month. And again, with 17 billion bushel corn that we produced in 2025, we're going to need every possible avenue of demand to use up that corn. A lot of renewed optimism maybe on E15 being able to make it in some must-pass legislation in Congress. Just yesterday, Secretary of Agriculture Rollins had mentioned that the ball is now in Congress's hands. The Trump administration's done everything it can to help with E15. And if they are able, the Trump administration has done some waivers, but overall corn demand, if you're able to go from 11% adoption right now, above the 10% blend wall, which most gasoline has at least 10% ethanol blended. It's an additional 240 million bushels of demand. If we get to that full E15, if we could increase and actually get retailers to have all the E15 pumps, consumers buying them, that could provide an additional 2.4 billion bushels of demand. So really a great opportunity to expand corn use here domestically. Iowa has done a lot to expand their E15. Retailers being able to offer that up to consumers, and consumers have willingly chosen that E15 to save some money. So the last thing, kind of as we look for future demand, sustainable aviation fuel is something that is, not going to happen tomorrow with being able to use more ethanol demand. We could see some more of the soybean oil, distillers corn oil used. Many of the renewable diesel plants can also run SAF. And so we have very, very small incremental increases in just overall SAF. A lot more needs to be done to really build out that industry. As we look forward, we are missing those targets of 10%. A lot more has to be done both at maybe state levels. The federal level no longer has a higher SAF tax credit. And so airlines are going to have to make those decisions. We could see some states step in and increase their maybe tax incentives to help push that industry along. And then the last thing I want to pull out, this is maybe not on a lot of people's radar, but the opportunity for maritime ethanol to be used in the maritime market, especially as they are looking to also decarbonize their fuel supply. Right now, ethanol is 0.001% of the total fuel supply there, but we could see that really expand, and if we just had 5% of the global maritime market, we could add 4 to 5 billion gallons of additional ethanol production, which again, as we are looking to find a way to use more of our very productive capacity here for corn production and soybean production, maybe some market opportunities there with maritime as we look forward. And so with that, I'm going to shift it over to Tanner. And Tanner, I'm going to see if you can make sure if I can hear you. You good?
Can you guys hear
Jacqui,
me?
Yes, we can hear you.
Jacqui, just before we go over to Tanner, you did have a couple of questions that I'd like to address before we shift over. One is about what % of their capacity are current soybean crush plants running at? Do you know?
I mean, we have continued to bring new facilities online. And so, and Tanner, maybe you want to add into this, but we are running at very, for the crush facilities, running at either near capacity or very high, close to full capacity for those crush facilities. Now, the biodiesel facilities or renewable diesel facilities, they may be running less, but the actual crushers, I believe, are running pretty close to capacity.
Okay. And then another question that came in was at the very beginning of your presentation, you had a slide that looked at cost per acre of production. Do you know what I mean? Could you go back and just review that again? It was close to the beginning of your presentation.
Yep. So I'm going to actually just do this because it'll be easier. So
yeah, that's fine.
Yep, cost of production. Oh, that's fine. We'll go here.
Yeah.
Okay.
Yeah. So if you could just kind of quickly recap this one, looks like costs are up across the board, for at least from last year, if not from prior years. And of course, we know prices are down or are either flat or down. Any other conclusions you can draw from that?
Yeah, so I mean, fertilizer costs are up. We're seeing fertilizer cost up. We've seen a little bit of decrease in fuel cost. But as you look at line by line of cost of production, we have just not seen anything come down enough to offset those increases. So, 3% is you don't think, well, that's not that much, but when we have commodity prices that are 50% lower, that 3% feels a lot more. You think of overall just normal inflation for food prices, for instance, 2% is kind of a normal increase. So, a lot of these costs are up 2 to 3%, which doesn't feel good when we're in these tight margins, but it's also not that far out of the realm of just a normal increase in the cost of doing business. And that's really where we're going to see this year, especially producers are going to have to do some of that pencil pushing to figure out, do we reduce some applications? Do we spend $250 on a bag of seed corn versus $300? But what kind of offsets does that bring when we're looking at pesticide pressure or seeding rates? Do we use fewer seeds per acre to stretch that out? I think we're hearing from our customers that agronomy inputs are going to be lower this year just because of these high costs. Now, these are just USDA's average numbers, and this is what's forecasted. So, every farm is different. Every farm is able to manage those costs differently as well. And that's what every producer has to make that decision as they look into this growing season.
Great. Thanks for that recap. And then for a question, for those of us that are not experts in this field as you are, what is the difference between renewable diesel and biodiesel?
Yeah, great question. So the easiest way to explain it is that renewable diesel is a drop-in fuel. It is very similar to diesel, so there's no limitations on how much you can use. Biodiesel, meanwhile, you can only really use up to 20%. A lot of times it's used at a blend of 5 to 10%. But some of the characteristics of a biodiesel, it adds a little bit more lubricity into the fuel. So there's some benefits of being able to use biodiesel, but the way it's produced is different, but the feedstocks are the same. So you can still use soy oil, distiller's corn oil, you can still use used cooking oil, beef tallow, white grease. It uses the same feedstocks to produce that, but we're seeing in California a huge surge in renewable diesel because of their low carbon fuel standard. The fact that you could have a 1-for-1 drop in is why you're able to see such high amounts of renewable diesel. We're actually producing more renewable diesel today than biodiesel because of the fact that you can have these high inclusion rates.
Okay, thank you very much. That covers the questions that we had for you. So let's go turn it over to Tanner and let you go ahead.
Excellent.
All right, thanks, Chris, and thank you for setting all that up, Jackie. That's a fantastic foundation for where we're at in the grain markets right now. Jackie talked a lot about biofuel demand, and she referenced the report yesterday that was a bit of a bombshell from USDA, especially when it came to their corn production numbers. USDA had raised their corn yield estimates to 186.5 bushels an acre. The market was widely expecting the USDA to actually cut yield because it was a little bit dry in the east, and there was southern rust issues, fungus in the Corn Belt. And so when USDA came out with those numbers yesterday, with what it comes down to a 17.0 billion bushel crop, about a 10% increase over the last record we had, we've just got a phenomenal amount of corn. What are we going to do with all this corn? Not to mention, we're also swimming in a world of soybeans. USDA also raised their projection on world wheat. Folks, we've just got a lot of commodities out there, and so what are we going to do? So we turn our focus to demand management. Some of you who may have farmed in the 80s, if you're still around, or if you survived through the 1980s farm crisis, you may remember the government approached that situation with supply management. Remember, with CRP and set-aside programs, things like that, that removed crop production off the market and thereby reduced supply. But the consequence of those programs is that we just simply sent acres overseas to countries like Russia and Brazil, and they filled the void. So this time around, rather than doing supply management, we are now looking to the government for demand management, and we're all sitting there on pins and needles what USDA is going to do with the RVO, the Renewable Volume Obligation. We simply have way too much commodity. And unfortunately, as is the case with anything government related, nothing really moves quickly. And so here we are dealing with an abundant supply. And Jackie, I can't see what chart you have on the screen. If you can go to the commodity indices chart.
Yep, that's what's up.
Okay, thank you. Sorry, folks, we got some technical difficulties on my end. I'm not able to see the charts. The chart you're seeing on the screen right now are the indices of the major commodities. You have grains, livestock, industrial metals, things like copper and aluminum, and energy, things like crude oil and natural gas. And then I'll throw in there for fun the US dollar. And clearly you can see the grain markets have not kept pace with other commodity markets, specifically industrial metals and livestock. Livestock has been on a long-term trend, rather, we'll say. Here recently we've had a correction in cattle prices. But Jackie had mentioned earlier a smaller beef herd in the U.S., the smaller hog herd globally. The Chinese are shrinking their hog herd. So we've got some supply issues there that's lifting prices. Industrial metals are climbing. Much of that owed to the fact that we have the digital infrastructure, if you will, building out of cloud capacity and for AI production capacity, things like that. That's requiring industrial metals. And so as a result, those commodities are going up. But if you look at grains and energy, we are down for the year. It's really been grains have really been the downside leader for most of the past year. For all the reasons I just talked about, we are simply not short of supply of any of the major commodities. In fact, if you look at global productivity for grain, or for all the grains and oilseeds, we are at record high yields for every single crop. There's only one crop I could find that was not record high, and that was sunflower seeds. Everything else, corn, wheat, soybeans, rapeseed, rice, you name it, everything was record high yield. We've simply not had any weather hiccups to speak of around the world. And so that is why grain markets are so low. Excuse me. I got to sneeze here. At the same time, I do want to point out that the dollar has been weaker as well. That typically is associated with higher commodity prices. But as I said earlier, grains have defied that macro trend. When the dollar is down, commodities tend to go up because our exports become cheaper overseas. That has not been the case because, as I said, we are in a supply abundant situation, both here in the United States and abroad. Jackie, you can move to the next slide, focusing in on what's going on the crop side. We have a situation where most of the crops are down, save one crop, and that is soybeans. Now, if you don't come from the world of agriculture and you only read the New York Times every day, you would be under the impression that soybeans would be the downside leader of the crops. That's not been the case, simply because we did harvest a smaller soybean crop this year. We did expand domestic crush a fair amount. And so for that reason, soybeans have actually ended the year as a bit higher versus the other commodities. Rice prices there have been the downside leader because of India dumping subsidized rice on the world market. But you don't think you grow a lot of rice up in your neck of the woods, so we'll just put there for a point of reference that corn and wheat are down, but they're not nearly down as they're not down as much as rice or cotton. Jackie, if you can expand to the next slide. This is some proprietary data we have here at CoBank. This is our borrowing base data that our folks in our borrowing base department. Special shout out to our friend and colleague Justin Weigel, who pulls this data together for us on a monthly basis from all of our grain co-op elevators around the country. And what you're seeing here is the percent of bushels that are company owned on October 31st. We're going to have updated numbers here in the next few days. That'll be for the end of November. That's going to correspond with USDA stocks data on December 1st inventories. We're going to talk about that here in a moment. But as you can see here, I want to point out soybeans. The percent of bushels that are company owned went up. What does that mean? Company owned bushels, which means the farmer sold them. Okay. Farmer sales of soybeans leading into the end of October were up substantially. Okay, there was a lot of farmer selling going on because probably assuming here, I'm assuming that farmers were thinking that we were not going to get an end soon to the trade war with China, and so they wanted to get out of soybeans. And as you can see here with corn and wheat, their sales were actually down. Okay, farmers are not happy about prices, obviously. I don't think that's a surprise to anybody listening. So what was going on here with the soybean sales? Soybean prices were not great either, but they were getting out of soybeans and holding on to the corn and wheat because they feared things might perhaps get even worse with soybeans. Now here we are. There was a rally in soybeans after the trade truce with Trump and Xi Jinping, and soybean prices did rally. We are now on a corrective path once again with soybeans, now that the market has digested what has happened. The White House advertised that China was going to buy 12 million metric tons. from the U.S. this crop year. That was highly doubtful until it kind of happened. We're not there yet, but we're almost there. We're on the way. About 10 million tons, so thereabouts, have been sold to China since this trade truce. But the market is not surprised by this. It's already been priced in. So now we need a new demand driver, because we are struggling with the new Brazilian soybean crop. USDA pegged that crop yesterday at 178 million tons. Private estimates put it more at 180 million tons. Folks, that's a lot of soybeans they're going to need to find a home, and so the market is now pricing that in. Now, looking towards the contracts that farmers are using, basis contracts. Taking a look at that, what is a basis contract? Farmers lock in the basis, and then they set the board price at a later date. More farmers are using basis contracts for corn because corn demand has been so strong, especially with exports. Record pace, in fact, for exports on corn. Domestic usage is good, not phenomenal, because we are not seeing the increase in the livestock numbers because of a slow rebuild of the beef herd, shrinking hog herd, and a modest increase in poultry demand. Ethanol demand is good, not phenomenal, because of grain sorghum. I don't think you grow much grain sorghum in your neck of the woods. That's mostly a crop for the central and southern plains. The story there is we have a lot of grain sorghum looking for a home because China is the #1 export destination. Same story with sorghum that we saw with soybeans. China stopped buying sorghum, and so now we literally have mountains of grain sorghum in Kansas and Texas and surrounding states. And the ethanol companies in those areas are leaning on that very, very cheap milo to produce ethanol, and that is cutting into demand for corn. But bottom line here, basis has improved, and so as a result, farmers are utilizing basis contracts to lock in that stronger basis and set the board price later. Jackie, if you can move to the next slide. This is a chart on delayed pricing, or DP programs. Very risky program to be using when you have a demand surplus, or excuse me, a supply surplus environment like we are in right now. Basically, you transfer title over to the elevator, and then you can price the commodity later. Well, we got a problem, folks. We got too much commodity looking for a home. And if you're doing a DP program, your opportunities for marketing grain or oilseeds is probably in the rearview mirror. We will perhaps see some weather hiccups this spring that may create a rally for you to price grain. Unfortunately, though, you're probably paying a fairly high fee to manage this position, or to manage this contract at the elevator, because the elevator doesn't like these programs because it's risky for them to price grain in a carry market like we have right now. And so for that reason, you're seeing declining participation in these contracts. If you do have a DP program, talk with your elevator about maybe you can work with them on the management fee. Otherwise, it's going to be really hard pressed to find a marketing opportunity in our supply surplus situation we have like right now, unless we really start to see some weather hiccups around the world, but that's not materializing right now. If Jackie can move to the next slide. Corn stocks on December 1st were record high. No surprise after the monstrous crop that USDA reported this last fall. There's a lot of bushels looking for a home. A lot of those bushels, as I said, were marketed under basis contracts. There will potentially be some weather situations later on this spring that may cause a bounce in prices. So if you have a strong basis that you're able to lock in, that's great. That was very smart of you and prudent to do that. Now you just need to figure in what's going to happen with the board price. We did lose 20 cents or so yesterday on the board. We got to find some new demand, folks, in order to clear out these inventories and find a new leg up on prices. And right now, we've just got so much supply on the market, it's going to be pretty hard pressed to find those rallies. Percent of corn that's unpriced from the farmer is up. So what that means, and when there is a rally, farmers are going to be there to sell it. Okay. So keep in mind that your neighbors are probably going to be very eager to lock in higher prices as well. Based on these numbers right here, you can clearly see that farmers are looking to lock in those board prices as we discussed earlier. So when there is a pop in the market, you can anticipate there will be some heavy selling that is accompanied with it, and it's going to be short-lived. So you're going to have to be a nimble marketer in this price environment. Next slide, Jackie, please, is the U.S. soybean stocks on December 1st, also up from last year. We harvested a smaller crop, so why are stocks up over last year? That's because we lost a lot of that Chinese demand. Our total export demand as of January 1st is down 29% year over year. Although we have increased domestic usage for renewable diesel and biodiesel, as Jackie talked about earlier, that has been absolutely a positive. We haven't made up for it yet because of the loss of export demand. And it's going to be hard-pressed to find new export demand now that the Brazilians are probably going to be harvesting a mega crop. It may be 180 million tons, folks, and we've got that kind of supply bearing down in the market. Our export competition overseas is going to be pretty intense. Unpriced bushels, next slide, Jackie, are down. As I mentioned earlier, farmers did sell leading into this, and so there's not as many bushels looking for a home based on the basis contracts that we've seen, and so there is going to be a little bit less selling pressure because, like I said, farmers already sold. But remember, there are still a lot of bushels out there looking for a home, and that's made more problematic with the arrival of the Brazilian crop. Last couple of slides, Chris, and then we'll open it up for Q&A. Wheat stocks nationwide are up over last year. We did harvest a bigger wheat crop. It was the biggest wheat crop in the U.S. in 5 years. And we have had phenomenal exports thanks to the low prices and a weaker dollar. That has absolutely been a success story for wheat. We have been able to buy back a little bit of our export markets. The problem is that we've got Argentina and Australia harvesting mega crops. Argentina harvested the biggest crop on record for that country. Australia, same thing there, a very big crop. And so this time of the year, we're going to be getting some intense export pressure from the southern hemisphere harvest. And so we're probably can anticipate a slower export pace going forward, and that's going to slow down our ability to clear these inventories. Last couple of slides here, Jackie. Next slide on bushels that are unpriced. You can see here, farmer selling did slow down because of low prices. So there is going to be some selling pressure when there is a rally. And then, of course, looking forward, what does this all mean? The last slide on U.S. planted acreage. It's going to be a battle for the crop that is the least bad. I hate to be so negative, folks, but I don't think anybody's new to this market. It's been tough. Our estimates are that we are going to see a retraction of corn acres in that 93.5 to 94 million acres currently. We are doing some more research on this, talking to all our customers around the country, surveying them on what they are seeing on seed sales or chemical sales or what their contract sales are with farmers for new crop, and try to get some new data there on directly from the marketplace on where this is heading. But that's what, bottom line, we're anticipating a shrinkage in corn. Not a huge amount. It's still fairly high. But we are going to see, we think, a tremendous increase in soybeans. This could all change if we see the Brazilian harvest really bear down on the market. Then maybe soybeans may not be such a viable opportunity come planting time this spring. Wheat acres is going to be down a little bit, mostly owed to the fact that wheat is really struggling with ample supply globally, and so what we anticipate is perhaps another shrinkage in spring wheat acres. But there again, it comes down to what happens really with soybeans. You may find some farmers this spring who say, you know what, this Brazilian crop was just simply too big. I'm going to go back to spring wheat. So a lot to follow here over the next weeks and the next few weeks and months leading into spring wheat, spring planting. But these are our thoughts right now. Chris, back to you if there's any other thoughts or comments that we need to entertain.
Yeah, so a couple of questions came out. One is we talked about, or Jacqui at least talked about the price of input costs going up pretty much across the board, except for perhaps motor fuels. And what do you think some of the drivers of that are? Do you think that the consolidation in the supplier ecosystem is driving some of that, less competition?
Jacqui,
that's for you. Let you have that.
You
No,
know,
thank you. I don't want to touch that.
yeah, it is hard to see cost decrease. And I think when you also look at the fact that we do have some tariffs that are impacting some of our ag input costs, I think overall we have about a 9% tariff now on ag inputs. So it's hard to see cost decrease when you have geopolitical issues that are going on that are driving up some of the fertilizer costs. We have some anti-dumping tariffs that are on some of the fertilizer components. Pesticides, we're seeing Monsanto in court cases. It's higher cost everywhere. I think it'd be hard to correlate consolidation with it. It may have an impact, but I think overall, it's hard to bring the overall cost structure down with all these other outside influences also impacting prices.
Okay, yeah, that's fair. I think the underlying cost structure is probably the biggest factor, but I think it's also kind of undeniable that on the upstream and downstream side from the farmer, in terms of the input side and then the processing side, there certainly has been substantial consolidation in both of those areas, for sure. Another question that came up, I'll put this one to Tanner first. So if you're a row crop farmer, and you're looking at this environment, what should be top of mind for you going into your crop decision making process for 2026?
Yeah, from the producer standpoint, it's always goes back. You don't farm for yield, you don't farm for cost, you farm for revenue. And so you got to figure out obviously what your cost of production is to begin with. That's baseline, and perhaps you might be able to shave some costs on certain inputs. There can be a negative impact on yield when you start doing that, but you have to sit down and run your numbers about what kind of cost of production can be negotiated on seed, on chemical, on cash rents, on fertilizer. I know that fertilizer is a big one for corn and on seed. And so that may be an impetus there to switch it over to perhaps another lower cost crop. But again, it comes down to what your local market is. I mean, I've heard for years, farmers in the Corn Belt saying, well, we need to get out of corn to some of these other lower cost crops like oats or small grains like wheat and things like that. And indeed, they are absolutely lower cost. Where's your market? What is your transportation cost to that market to bring those crops to market, or your cost of storage, things like that? All of that has to be factored in. All of this requires a much sharper pencil, perhaps, than what you're used to. So if you are entertaining other crops outside of the big three, corn, wheat, and soybeans, you got to see what local markets are available. If there is nothing local, then what's your transportation cost? That transportation cost is absolutely a big one. And then, of course, work with your landlords. Can you negotiate a lower cash rents? And your banker, see if you can sweet talk them into a lower spread on their loan.
Yep,
that's hard to do, by the way.
Yeah. So speaking of that, when we talk about planting decisions for farmers, there's kind of two ways to look at things. One is costs up, revenues down. Maybe I should pull back in my planting a little bit and plant fewer of those marginal acres and concentrate on my best fields. Another way to look at it would be that because prices are down, I need to plant fence row to fence row and maximize my revenue. Any thoughts on which direction things might go in terms of like some of those more marginal acreage?
It's going to be harder to pencil marginal acreage because the yield isn't going to be there to support your cost like on your prime ground. And so, you know, those marginal acres are absolutely going to be up for question. I'll reference the data yesterday on USDA's winter wheat acreage report. That was surprising. Winter wheat acres hardly budged. Everyone was expecting to come down, but it's held steady. Now, what's going on there? Perhaps it is because wheat is a very cheap crop. You can bin run seed pretty easy. You don't have to pay for it. And you can perhaps use that as the crop on your marginal acreage because wheat performs better on marginal ground than your higher cost crops like corn or wheat or corn or soybeans or alfalfa even. So there may be a room there or maybe some opportunity there to plant some of those marginal acres to some lower cost crops. But again, you got to run those numbers about what your market is, where they can be delivered and what kind of price.
Great. Another question came in, and I think I'll take a first crack at it actually. It was, do you see farm credit pulling back at all and making fewer dollars available to growers to perhaps plant fewer marginal acres or just in general in the row crop environment? I would say that farm credit, our position is that we're there for our customers in good times and bad. And so our commitment to, agriculture in general and row crops in particular is kind of unwavering. Having said that, if there are farmers that are really struggling with higher costs and persistent losses, we're gonna have to have some tough conversations because we don't want to erode equity in farm operations if there's not a sign of things turning around. As far as the acreage that gets planted, I think we kind of leave that up to farmers to make their own decisions in terms of planting and what acres to plant or not. So I guess I'll kind of leave it at that. But do you have any thoughts on the credit environment, Tanner or Jackie?
We're hearing
Jackie had the slides on that.
Yeah, I mean, we're definitely hearing that it's requiring more lenders want to have a little more assurance that there is some money there, and that's why we're going to see like the farm payments being used for some of that working capital or paying down debt. Any cash that's where it's going to have to go. We're going to see less investments in machinery or even expansion for producers, especially in those producers who are experiencing those extreme tight margins.
Great. And I am aware that we're over our time a little bit, so I'm just going to pose one last question for Tanner. Do you see things turning around at all in terms of like global supply and demand, or is this like kind of a new normal now where, we're in a global surplus situation for grains and oilseeds?
I'd say it's a new normal, quote unquote, only as far as we can see out. When you have the supply that we have, that tends to carry over in the new crop years. You get bigger carryouts. And so absolutely, we're going to see this persist at least through the 27-28 crop year. If we don't see a weather hiccup at some major exporting countries like the US or Brazil or Russia, we're going to have to see something there on the supply side if we don't see a material increase in demand. I mean, we do see, obviously, biofuel policy here in the US, in Brazil, and other countries like Indonesia, helping to drive more demand. But at the same time, we still have a lot of supply that those policies aren't going to be able to take away, at the turn or very quickly, we'll say. So when we've got the carryouts that we have right now globally for corn, wheat, and soybeans, that tends to carry over on into the next crop year in terms of price drag. And so at least I'd say through this crop year into 2026 and 27, and then if we don't see a weather disaster anywhere around the world, then we got to figure that we're going to be bouncing around this low price environment for at least the next couple of years. But I'd say in the near term, definitely for certain into 26 and 27, we're going to see prices hang around these lower areas.
Great. Thanks. So out of respect for everyone's time, I'm going to cut it off there and thank Jacqui and Tanner for your excellent presentations. Couple of closing notes here. This webinar has been recorded. The recording will be archived and available at farmcrediteast.com/webinars. All of our webinars live at that address, past, present, and future. So be sure to check out that URL to see what webinars we have upcoming, as well as to access recordings of past webinars. We have Outlook webinars for most of our major loan sectors scheduled for this winter. So be sure to tune in for that. And with that, I'll thank Jacqui and Tanner and CoBank Knowledge Exchange. Thank you very much.
Thank you.
Thanks, Chris.